Hello and welcome to China Stock Market Analysis presented by me, Jack Kuzi. I am a fund manager here in Sydney, Australia, who takes a very keen interest in Chinese financial markets, particularly its stock markets, whether it be the Hong Kong Stock Exchange or the major bourses within China. This has always been a passion of mine, and the reason for this channel, and this is our first video, is to cover more in depth around China's stocks, its performance of its markets, why it's performing, why it's non-performing, which has been the story for the last 3 to 4 years, particularly. Often you get a lot of information around China's general economy, what the government is doing, the fifth plenum, the direction. We talk a lot about its politics, its internal politics, its Politburo, the structure of its economy. We talk about its relationship with the rest of the world. We talk about its overarching trade or manufacturing data. But I feel what is lacking is some analysis around its stock market, its companies, how they're performing, how they might perform, and why they haven't performed in the past, and give possible investors or current investors in the Chinese stock market some of my insight from my 20 years of investing in markets and the last 10 years of investing in Chinese markets and covering Chinese markets in particular. So that's the purpose of the show. Every week we're going to do a weekly recap. I'll cover the biggest stories in China's stock markets in particular. I'll give you my insight, I'll give you my opinion, and I'll let you make a decision on that. As the channel grows and hopefully people care, and will view in, and we get more viewers and more subscribers, what I'll try to do is get some guests from around the world, some subject matter experts on key markets, on key stocks, on key areas of the Chinese stock market to help you make better decisions. That's the purpose. So if you haven't subscribed and you think this might be of an interest in you, hit that subscribe button and that will really help me go along. This is the first time we do it. I've done things previously under different names like this, but I really hope to get some consistency around this in 2024. Bear with me as we continue to go smooth out this weekly wrap. But without further ado, let's get started. And before we get started, let's do the odd disclaimer. Anything or content or video of this information doesn't constitute a recommendation to purchase or sell securities. It's not intended to be and never will be intended to be financial advice. No guarantees or warranties. Everything I try to do, I try to keep it as factual and up to date, but I can't guarantee it. And just remember, this is my own personal opinion. Now, if you disagree with my personal opinion, if you don't like it, let me know if you agree in the comments box, and I'll make sure that I respond to you around what is going on. Right, so I guess what I want to further say is some people might be thinking about investing in the Chinese stock market. Now remember, foreigners can only invest in the Hong Kong market, access Chinese stocks there, and of course a lot of Chinese stocks are listed in the US markets and foreign markets. So you may be thinking about making a decision to invest in it, or you might be invested in it at the moment. If there's anything that you want me to cover, let me know and I'll do my best to do so. Alright, so what we're going to do is we're going to run through today's agenda. We're going to go through the market wrap. We're going to talk about probably the biggest story coming out of China this week, which was the Evergrande. We had the ruling from the Hong Court judge. Enough is enough was the title. We're going to talk about Snowball Derivatives, which are quite unique to the Chinese market and have led to some of this forced selling, which is, I guess, made the selling that we've seen, particularly on mainland and Hong Kong exchanges, much, much worse. I'm going to cover an article written by the Financial Times. We're going to look at CATL, or CATL, and their current forecast and earnings. We saw a big pop in the share price on the back of that. And we're going to also talk about BYD, which is, on its way to becoming the largest EV company in the world. And then we're going to generally talk about China's EVs. We're going to cover some of the geopolitics that's occurring around that, some of the restrictions that are coming in place or possibly could come in place for European markets that's going to affect Chinese EV exports. Of course, the ongoing tension around this major technological sector that is, eventually everybody's going to be driving an EV around the world. Well, that's where we're going, between the US and China around that. So that's the broad agenda. I'll give you some of my insights. We'll also look at some quotes from other people around the world who cover these markets. And of course, leave a comment in the comment box if you have something to say. All right, let's get started. Okay, let's take a look at the performance for the major indexes within China. We'll probably broaden this out a little bit more. I incorporate the star index as well, which is kind of like China's equivalent to the NASDAQ, give or take. It's hard to get these figures in one place. I used to use TradingView. Seems more difficult to use these days. However, let's have a look at the Hang Seng. So I may have alluded it was February 3rd. It's actually February 2nd here in Australia. So 26th to the Feb 1st, we saw a change of 2.4.2% to the downside on the Hang Seng. The CSI index was down 3.48%, and the Shanghai Composite Index down 4.79%. And you can see the openings and closings from January 26th to February 1st. So, yeah, not a great week for Chinese indexes and Hong Kong, and not a great start to the year after a continuation of a few bad years. You've got to remember, coming into 2024, the Hang Seng was on a 4-year losing streak, its longest in history, and the Shanghai Composite was on a 3-year losing streak, its longest in history, I believe. So definitely no confidence in Chinese markets, and the biggest story of the week would certainly have dented confidence from foreign investors, and that was Evergrande. So Evergrande had a filing in a Hong Kong court where a decision was going to be made to restructure its debt or put it into liquidation, and that's what the judge had said to, I guess, the creditors and the company itself. That came on the 29th. Now, the stock closed trading before the court case decision. It's currently traded at 16 cents just before it went in. It'd been like levitating between that 20 to 21 to 22 to 19 for quite a few weeks in the anticipation of the court case. To be honest with you, I'll be very frank, I was thinking about buying some because I didn't think that they would let this go into liquidation. You know, I know from things that I've read and people I've spoken to, China is very wary of a Lehman's style crisis, and everybody's been calling this a Lehman style for a while. But I just didn't think they would offend foreign creditors so much. You got to think that as a foreigner now from overseas, are you willing to purchase Chinese bonds if you're going to be left in the lurch? Now, there are some nuances here. For example, Evergrande will tell you that it was only the HK listing that was put into liquidation, not the mainland listing, which doesn't affect it. That's, that's sure, technically, that might be right. All right, so let's get into what happened, and then I'll give you some of my thoughts on it. So the judge said enough is enough, ordered the liquidation of China Evergrande Group 3333.HK, which is its ticker code on the Hang Seng. Justice Linda Chan's decision due to Evergrande's lack of restructuring. Now, from what I've read and what I've watched, they were scurrying to restructure the debt. Basically, they owed a lot of people of money. You restructure it by, possibly pushing the repayments down, kicking them out, offering some shares. They did try to offer some shares in the previous restructure. That was rejected from my understanding. They had liabilities exceeding $300 billion, which is 2% of China's GDP and is larger, I believe, than the GDP of Russia. But don't quote me on that. That might not be right. No, that's not right. Liquidation is complex. It's complex because this is a Hong Kong ruling. Most of the assets are on the mainland. Hong Kong jurisdiction doesn't apply in China. Whether they want it to or not is the question. I mean, we are dealing with China. Things work differently. That's a big question. There was an agreement signed in 2021 or 2022 to allow for things like this. So a ruling from Hong Kong to be implemented on the mainland and vice versa, but it's never been applied to this size. It's got $240 billion in assets. Obviously, this is significantly impact China's property sector and economy. The CEO assures investors and people. Now remember, a lot of people have paid for their houses already or put sizable deposits on properties within China in a market that's already bleeding and is down in excess of 30% in some areas of China. What else we got here? Oh, that's not from us. So trading in Evergrande was halted. And here's some of the, I guess, the situation adds to basic economic challenges. Here's the thing. Chinese property was a bubble, and it bursted, but it was the government that came and bursted it. Now, has it gone too far? I think it's gone too far for their liking. They are trying to, boost some of these failing developers with some short-term loans. They're easing restrictions on leverage. They're doing everything they can to, stop this falling knife from continuing to fall. But it's not a great look. It's not a great look for China, particularly for foreign investors. I mean, who's going to buy Chinese bonds if you're not protected now, if they lose their money? And in a country that is trying to get foreign direct investment, had its first quarter drop, I think, in the last 30 years, it's not a great look. I continue to say on some of the radio segments and TV that I do, China's got a PR problem. This just further emphasizes that PR problem for them. Now, the question is, how does this apply to developments on the mainland? There's still uncertainty if customers receive their homes. If they do liquidate it in China, who gets their money first? I'm going to say it's going to be unsure. It's going to be suppliers and it's going to be Chinese citizens because of that, social stability framework. I think the Chinese government will bail out Chinese citizens on properties that they've bought. So let me move this over a little bit, sorry, so I can see some of my notes here. It's got 110,000 employees. What happens to them? That'll affect social stability within China. What happens to the further properties? Do other developers come in and take them over? It certainly doesn't assist with the consumer confidence. Remember, a lot of Chinese citizens' wealth, the rich, the medium class, and the poor, has been made through property. And it's collapsed, so that they're saving their money more, or they're paying down debt more because property prices have collapsed. You talk about that Japanese no growth situation that they had. The Japanese property market collapsed. In response, Japanese citizens started to save more money and repay debt. When you save more money and repay debt, you're not investing, therefore you have no growth, which what Japan had. I know China is very well aware of that. They've watched the Japanese situation. One thing we know about Chinese authorities is that they think very, very, very long term. What happens to other developers here? But I think the key takeaway here, particularly as a foreign investor, is I'm very surprised that they'd let this happen. Sure, it was a Hong Kong judge, but we all know that the CCP can place calls into Hong Kong or back channels and get what they want. Maybe this is like a 90s type clearing out the dead companies and the zombie companies that the US did in the 90s. China has had an excessive debt problem. Shadow banks, over leveraged. Chinese President Xi says, houses are for living, not for speculating. And, trees can only grow so high. So I just think from a public relations issue, this was a big swipe to China, considering they're trying to encourage foreign investors to come back into China. And I say this again, who's going to buy a Chinese bond? Evergrande was continuing to build properties ever through 21 and 22. As of late 2021, they had 1,322 unfinished projects, with government involvement expected to ensure completion. It's got 102,000 employees. Like I said, the crisis may lead to bankruptcy for other developers, and it's part of this, real estate collapse that's significantly affecting consumer confidence. Your asset prices dip. you feel less wealthy, you spend less money. It's called the wealth effect. It's a theory, but I believe in it. Interesting to see what happens here when the authorities step in. What happens to the Hong Kong listing? Whether foreign investors get any money back. But to be honest with you, I did not expect this to happen. I've got a quote here from John Brigander. For international investors, this is a pivotal moment, and what happens next will help them determine their legal strategies to recover anything from other developers that have defaulted. John Brigander, head of DebtWire, New York-based data provider covering global debt and bankruptcies. This was certainly the biggest story coming out of China this week, and it certainly was a global story. Let's see what else happened. All right, so let's cover this one. And this was an article written by the Financial Times on the 25th of January. So you can see it there, and I'll drop the article in, I guess, the profile of the notes section of the channel. And it talks about Snowball Derivatives. Now, there is a similar concept on the Hong Kong Stock Exchange, kind of similar, called callable bull-bear contracts, where a strike price is reached, and therefore you need to sell down assets as they go along. This one talks about Snowball Derivatives, and I've got a bit of a description there taken from the article there by the Financial Times. So in order to get interest rate payments or high interest rate payments, you get them as long as the indice, let's say the CSI 300, stays between a certain range. So just pulling numbers out of thin air here, as long as it stays between the range of 300 to 600, then you continue to receive interest rate payments, right? If it drops or rallies above those levels, therefore you lose your money, pretty much. So what's the appeal of it? It offers potential steady returns and stable market conditions. Its risks are significant losses. Pretty much you lose all your money. And it's grown substantially in size in the Chinese market. Now you've had this, enormous volatility, particularly to the downside in Chinese markets, and it's resulted in some forced selling. So what happens is the product offerer, in order to hedge their situation, might buy futures in the corresponding market. Now, if the range is then triggered, they are forced to sell those futures in order to, I guess, unhedge their positions. And of course, futures are directly related to the stock market, which then forces more selling in the underlying market. Now, we saw that last week when we saw the GDP growth target and the retail sales data come out of China. Particularly the GDP growth was a big miss, along with manufacturing PMI. And that forced some selling in the market. And then it's the snowball effect, right? So one sells, the other sells, and the market keeps dripping down. Now, the compounding effect that you're getting in Chinese markets is there's just a lack of buyers at the moment. You've got a lack of foreign buyers as foreign direct investment continues to whittle, and people see China's market as uninvestable, which I think is a little bit too extreme. And you've got a lack of, I guess, consumer sentiment or local Chinese buyers with some hope or strength in the significance of their Chinese market. So this has led to significant losses. The article estimates that the products are estimated to be at $45 billion US dollars, or 320 million renminbi, I should say, 320 billion renminbi. So due to a prolonged market slowdown, these contracts are incurring losses. What I thought was quite interesting is they ran through some quotes from some of the losers in these markets. So this was from a head of a medium-sized Chinese brokerage. The sales team will start the marketing by asking to their clients, do you believe that the CSI 500 could fall by more than 20%? Most people would say no. If not, you should buy a Snowball as a safe bet, head of a medium-sized Chinese brokerage. Some pretty, aggressive sales tactics. One of the investors, Stephanie Liu, a retail investor, said, I feel helpless and guilty because my friends It is a situation that has no solution. It's not the right question to ask why we bought snowballs, but why the index is performing like this. And that is relation to a Bido quote that you've got there. Let me go back to this. I mean, we talk about Chinese financial markets, and you'll hear a lot about wealth products that have been offered by significant companies. A lot of wealth products were offered around China's property market, which we've obviously seen a collapse over the last 18 to 24 months. I guess these kind of snowball derivatives or snowball products are increasing because people in China are looking for yield or income. You're not seeing any growth out of the Chinese property market, which has been probably the main source of capital growth for most Chinese citizens over the last 20 or 30 or 40 years. You have low interest rates in China, particularly when you compare them to the rest of the world. So putting your money in the bank is not giving you a yield. And the stock market simply hasn't performed and given those capital growth. So there's a lot of appeal for these type of wealth products or these snowballer products. Now, Chinese regulatory authorities said that they were trying to crack down on this. They particularly said this about 12 months ago, but we haven't seen that. A lot of the major boost or growth in wealth products are subject to things that happened in the 90s and the 2000s and the 2010s, where, again, investors were looking for yield. And China was trying to, suppress its growth, particularly in its asset classes. So when you look at, markets, particularly the week before, where we saw, kind of a drop and then just a significant drop as the market came down, a lot of that is because of these, what they call snowball contracts, or what they call in Hong Kong, callable bull and bear contracts. Brendan Ahern, who is the chief investor officer of Crane Shares, who runs a whole bunch of ETFs, actually does a really good report on these CBBCs and says it's a strike price that's hit, you're forced to sell, and then you have a lack of sellers. And when there's a lack of sellers, that only pushes the price down. And that's why we saw markets finish on those lows, particularly 2 weeks ago on the back of that data. So this is one to watch. This is, unique to the Chinese market. These snowballs are very unique to the mainland. And have led to excessive selling and excessive losses. What does this mean for the future? You've got to remember that because we're seeing a lack of foreign direct investment into China, and what I mean by this is there's a lack of foreign buyers for Chinese stocks. In order for Chinese stocks to rally, like anything, people need to be buying them. And with less foreign investors, someone's got to pick up the slack. And who's got to pick up the slack? It's got to be Chinese mainland citizens buying their own stocks or investing in their own stocks. And when there's a lack of confidence in the market, and when you get continual losses like you've seen, it leads to a lack of buyers. So it's kind of that self-fulfilling effect. We've seen in the last week or two, Chinese authorities call upon, their major funds to start to buy. And we also saw the Chinese talk about putting together kind of a national fund to start buying some of their stocks. And these are part of the reasons that they're trying to do that. Excessive losses lead to further selling, which very self-perpetuates it. And it's hard to get it out of that cycle before you hit an absolute bottom. So I thought that was a really interesting. I'll pop the full article or the link in the full article from the Financial Times in the profile box below. All right, let's take a look at some of earnings that came out during the week on the mainland. Let's first take a look at CATL, which is the largest battery producer in the world. You can see from that table there, they have 37.4% of the global EV battery market. Got some phenomenal joint ventures with the likes of Ford, which they've recently signed. A major component of EVs across the globe. When you look at China in general, they are the single biggest choke point for lithium batteries or ion batteries. And the single most important country when it comes to the production of ion or lithium batteries and EVs. And they're the largest EV maker in the world. They make more EVs. They are the biggest adopter of EVs. We're going to talk a little bit about BYD in that EV market a little bit later. But what we saw was CATL pop 7% on the day that this rose, or 7.7 as you can see in front of you. after announcing a potential 48% profit increase in 2022, boosted by global demand for power batteries and energy storage, defying a broader market downturn on the Shenzhen exchange where it is listed. A recent development that I thought was really interesting, which they talked about in this report, was the deal that they've done with Didi, which is the ride-sharing company within China, famously delisted from the US exchange after its IPO for not complying with Chinese regulations, where they're talking about building battery swapping stations. So I think the concept, it looks like, is, you're a Didi driver, you're driving around picking up, instead of sitting at a charging station for a half an hour, an hour and a half. And China's got a problem because the adoption of Chinese EVs, charging stations haven't caught up. There's often the story that you hear that when you drive around Shanghai in the high rises, you've got, tenants running power lines from their cars into their power ports in their apartments to charge their cars overnight, because power stations or charging stations are at a minimum or not enough to come up with the demand that China's done. We've got to remember China's adoptions of EVs are around 18%. Biggest in the world, biggest market in the world when you look at low 3s or high 4s within Western markets. So you're a Didi driver, instead of sitting there and charging, you go to these CATL made stations and they pop out one battery and pop one in and you keep going. Now this is a common concept that started to happen in China where they're swapping batteries instead of charging them. But I think this is a great move. And I also think it's a great move for Didi. Think about it. You kind of double your ride time, right? Time on the road for drivers. You pick up more people. You drive more revenue, which should help the bottom line for drivers, obviously, but also the bottom line for Didi, also. So, the growth in CATL was attributed to global EV adoption, obviously, and lower production costs. So despite a slight profit drop in the third quarter of 2023 due to currency fluctuations, CATL has maintained a competitive edge over smaller domestic rivals, and as you can see there, holds a 37.4% share of global market, making them the largest battery maker in the world for EVs. And I commented on that deal with Didi, which I think is very exciting, not only for CATL, but I also think it's very exciting for Didi. Stock I've been looking at for quite a long time, only because I think ride sharing is a great industry. You look at Uber or its counterpart in the US, who is just, share prices rocketed in the last couple of years because ride sharing is actually quite profitable. And often you find with new industries like ride sharing, you get multiple players, and then it gets dwindled down as you get 2 or 3 players. So, interesting the move there by CATL and Didi. And I think it's a great joint venture that they put together. And then further on, we got a report from BYD. So they dropped 4%. I live here in Australia. You're starting to see a lot more BYDs driving around here in Australia. And if you look at, we're going to comment on this a little bit later, but if you look at where is the next growth sector for Chinese EV players, your BYDs, your Li Autos, your Xpengs, etc., your Polarises, well, it's got to be overseas. You definitely, and they definitely want to go overseas. Now, hands down, the best EVs in the world are made in China. There's no doubt about it. The best EV cars in the world are made in China. In fact, I think they're years ahead from their competitors, with the exception of Tesla, of course. So their net income came in between 29 and 31 billion yuan, below analyst expectations of 31.5 billion yuan. So they dropped 4% after that report on the Hong Kong exchange. You can see some of those summaries of the report. I popped that through ChatGPT paid version and it gave me that nice little table. Estimate was 31.5. Quarter 4 net income projection between 7 to 9, so a little bit soft when you look at it at previous quarter's net income. Share price is decreased 16% in 2023, along with many Chinese tech stocks. Market challenges is a price war in China. So You saw Tesla at the start of last year, 2023, drop their prices within China, and you have a massive price war happening within China at the moment. There's a really good report called Sino Insights. He talks about January sales numbers in EVs coming out of China. And he says, they're disappointing in many ways, but he also comments, and I'm just reading off my sheet here, is that we should also remember that Q1 is historically a slow quarter since we just got out of gangbusters Q4, where automakers were all trying to pad their final year sales numbers, which normally means they pull Q1 sales into the Q4 timeframe. This past Q4 is no different. Also, and this is even more important, Lunar New Year is almost upon us on February 10th this year, so few people are thinking about what bargain vehicle purchase they should make. The other point that BYD made in its report was the European Commission scrutiny. So there is a move in Europe to start limiting Chinese EV exports into Europe due to security concerns. And this is a broader security concern shared by the West. So let's go on to that. And let me just talk about that in general, some of the geopolitical areas that are affecting Chinese EV makers, particularly when you're looking at where is the next growth stage for them. They're undergoing a price war within China. It's a highly competitive market. The next stage of growth would to be export their really good cars to the rest of the world, which has a yearning for electric vehicles and have maybe been undersupplied by more traditional Western makers. In the Crane Shares report, which is called China Last Night, Brendan Hearn, who is the CIO, which is the Chief Investor Officer of Crane Shares, says Hong Kong listed electric vehicle stocks were lower as Commerce Secretary Gina Raimondo called China-made EVs scary due to the potential data transfer. Then he goes on to say China's EVs are scary to US auto manufacturers who are incapable of building EVs or hybrids. Very true. At the scale and affordable prices China does. This is why the company should partner with US automakers to make them here in the US. If you look at the Inflation Reduction Act, which was passed about 18 months ago, there was policy in there to restrict the imports of China EVs, particularly around tariffs, around using a Chinese EV, but also using a Chinese battery within a Western-made EV. Okay, so you have that. However, because they're so good and they can produce them at scale such a low cost, it's almost inevitable that they're going to enter this market, which should help US makers become better. You get competition, you've got to become better. But the Americans particularly, and to the Europeans to some extent, are worried about data transfer. So if it's a Chinese EV and you're using it, and remember, EVs or EVs in general, they're built on software rather than that engine, you're collecting data at that point, and everybody's worried about how the Chinese will use that data. So this could lead to, new requirements on changing the software within Chinese-built EVs, making them more expensive. Example of software or data where it can be collected are maps and cloud services and your apps, etc. And there's also uncertainty on whether Chinese EVs will be used in military bases. You talk about China's relationship with the rest of the world, which has been a lot more sketchier in the last 2 to 3 years. This limits Chinese exports to the rest of the world. And, I think there would be, if they could get around these areas, if they could possibly, there's a report that President Joe Biden and President Xi are going to have a phone call in the next couple of weeks. And if they do, we'll cover it here on the weekly wrap-up. This would be a real boon for Chinese EV makers because, they kind of need it, considering the domestic market is saturated and highly competitive, and prices are coming down. So that's a bit of a geopolitical play when you're considering some of the Chinese EV makers, because they've got a better product, they can produce it cheaper, The question is, are they going to be able to sell it into foreign markets? And that remains a key question for the EV makers within China and the EV sector within China. But we'll follow it closely as we go along. All right, that's the end of the first China Weekly Market Wrap. I'll see you next week. If you haven't subscribed, please do. And as always, good luck with your investing.